This is Abhijit Chatterjee and Rohan Singh recording our weekly Charts Are Fun session. This is on Friday evening with a very exciting week this week with CPI data, and then markets literally had a big move, and in particular Dow closed above 40,000, a big celebratory thing. But interesting enough, we expect to see the party hats, but maybe because just overall everyone seems to be in a bit of a daze, because there are mixed emotions overall. There are still folks who believe that there are concerns whether that today's agenda, we will talk about the market. We'll talk about what happened in this week. This is the week of May 13th. So today we're recording this on the May 17th, the Friday. So we can talk about what happened in the market this week, and just give an overall market overview. We talk about the core ETFs, and then we talk about the sectors. There are 11 sectors. We talk about that. Then I'm going to go back to our barometer that we've been watching, the 10-year yield chart, the TNX. Talk about the core ETF for long-term treasuries, TLT. Revisit the QQQ chart. A very interesting cup and handle pattern had panned out there, especially on the hourly chart of QQQ. So revisit that, show how it met its target. And so now we have to look through and see what happens next. And then this was a big week of retail earnings, Home Depot, Walmart, and next week in particular, we have Nvidia. So that's the poster child of the AI run that we've had on the call of it the most magnificent of the Magnificent Seven. So we'll look at that chart. And then a big winner this week was not gold, it was silver. So in the precious metal sector, silver absolutely broke out and had a big peak. It was in fact the top performing core index ETF. So I'll talk more about that. So touch on that. So with that, this is our website. We appreciate if you could subscribe to our channel. And then if you like in the videos, if you could hit the like button, this helps us to share it with a broader audience of the way the YouTube algorithms work. We also have our blog site at Substack, chartsarefun.substack.com. Today in particular, we published a blog about Target. Target perhaps could follow Walmart in terms of some upside. It's also in the retail group, in particular in the staples, a sector that often is what consumers absolutely need versus want. This is a sector that they absolutely have to, from the day-to-day living, need retail items from Target and Walmart. So they are broader retail companies. So so this blog today was about the chart of Target, potentially a much bigger upside, but near term maybe kind of a upside towards maybe a 5% or so, 5 or 6% or so upside, and then maybe from there pull back, but something to look at. And then, if you look at the archive option here, you'll see all the other blogs that were published, the Target, and we talked about Chubb. This was the big secret position that Buffett's company, Berkshire Hathaway, was adding over the last several quarters. In particular, the last 2 quarters of 2023 is when they had requested SEC to kind of not make it public. So we looked at Chubb and see what the chart there was telling us. Smart money linked defense with staples. This was from a Barron's article from April. And interesting enough, we said that perhaps XLP, the sector ETF for staples, was headed towards 80. It had a good move with Walmart, and potentially with Target next week, this could perhaps be headed in that direction towards 80. And then we talked about grain commodity prices shooting up. And then in particular, this week was also an interesting week with meme stocks back in action, in particular the beginning of the week, and then they started pulling back. So in particular, AMC and GameStop were the two that picked up. And in particular, the one of the very popular tweeters, a guy who tweets at that point in the 2021 craze, came back after almost like you could say 3-year hiatus, and tweeted on Sunday. He's got the Roaring Kitty kind of handle, and this was an interesting tweet. You can see in this picture with a gentleman sitting on a chair with his video game console, and then leaning forward as if something interesting was about to happen. And that was just enough of a signal. As you can imagine, meme is effectively built on some form of a cartoon, some form of a character, or some form of a signal. And this was this meme that then get the whole Reddit universe and the set of retail investors who are active in kind of the herd mentality chase, and it had a very heavily shorted stock, GameStop. So GameStop, which was somewhere basing around the 10 to 15 to 10 to 17 region, took off from there. And basically, it had found a beautiful cup and handle, but the cup and handle was only measured up to 30, but the stock actually touched close to high 60s, 68. In fact, it was 70 pre-market on the day after on Tuesday, and then pulled back. Over the last 3 days, it has pulled back. And in fact, GameStop did pre-announce their earnings. They finished their quarter recently, and they pre-announced the earnings, and they actually are announced earnings below projections from what the market was expecting. So fundamentally, it didn't really justify the huge shoot up that happened. So this week, the key thing that did happen was CPI. CPI took the market by surprise. Market liked it because in particular month over month market was expecting 4/10 as in 0.4% increase, but it was 0.1 lower, it was 0.3. So that market loved a lot, and it kind of gave an indication to the market that perhaps the FOMC, Powell and company will likely not be as hawkish, and they may take a dovish stance, and that could perhaps mean that the interest rate expectations are now back in the expectations. So it had come down almost to perhaps one cut because we got 3 back-to-back hot CPI. But it's not that the CPI was very tame. It was just 0.1% lower. But there's a very interesting site, wolfstreet.com, and I follow them quite actively, published something very interesting that while it seems like from the month over month miss that, okay, it's possibly, CPI is taming down a bit. But if you start looking at something that the Fed follows more important, because month to month you get gyrations. So this blue line is showing you the month to month, and it keeps fluctuating all over the map. But smoothen that out and take a 6-month moving average. So take every 6 month, average out the inflation, and then you keep sliding that window every month and get the last 6 months. That 6-month moving average actually did bottom out, and over the last 5 or 6 consecutive months, it has been climbing to the fact that this part called the core services CPI, and CPI's components, whether it's goods and services forms the core of almost 60% or so of the CPI index, the composition. That has been steadily climbing. And in fact, that 6-month moving average now is short 6%, getting closer to what we saw towards the 2023 level. So over the span, you can see a W-shaped bottom and been climbing. And for 5 or 6 consecutive months, this has been on a steady upward trend, now almost touching 6%. So while the market was rejoicing and celebrating that 0.1% drop of the CPI, in reality, this is still a concern. And I'll touch base about the 10-year yield chart and still explain that there's still a possibility that market might be celebrating a bit too early on this. Also, you see this from the core CPI, which is the services and the goods combined, and the core CPI is touching 4% when Fed's target is 2%. It actually bottomed out somewhere closer towards the 3%, and also where each black dot is a month of CPI, 6-month moving average, and the 6-month moving average on this also is at 4%, lower than what services is, which is 6. But the fact that this one is also climbing consecutively over the last 5 or 6 months is a concern. It's something that there's a trend, and the trend so far is inflation kind of on a rise, something to be worried about. So what happened in the market? So let's just look at the core ETFs. These are ETFs of the market core indexes. The best performer, and the way we are sorting this out is by the rate of change over the 5 days, which means over the week for the last Friday to this Friday, what happened? Well, silver, which ETF is SLV, was the best performer at 11.72%. So that's an astonishing move. And you can see that it had an absolutely parabolic move. So it came back over the middle of April to the last part of April. It came back and kind of tested. So there are the 20 and the 50 moving averages, 20 in blue and 50 in red. It pulled back towards the 50, didn't exactly touch the 50, but came close to it. And then from there, it just took off. And with the inflation data, which came out on Wednesday, we could see, and this time actually usually PPI comes after CPI. This time PPI came the day before on Tuesday, and which was also not too hot. It was reasonably well accepted by the market, but then CPI is where it took the SLV really, by a big move, and then kind of a flat day on Thursday, and today again a big breakout on silver. So silver, interesting to the gold, actually has industrial use. It's not just a precious metal; it also has industrial use. There is a supply shortage kind of question that's popping up a lot among the miners and so on. And this actually, I'll show you a chart, has a target closer towards 31, 32. So the fact that today it closed closer to 29, there's still a couple of bucks more, or $2 to $3 more upside on this SLV ETF. And I had talked about it in the past. Bitcoin had a nice strong move this week as well, and the proxy here is the most popular by the largest money assets in this ETF is the Grayscale GBTC ETF. So this also had you could say a little bit of a cup and handle move. So from somewhere in the 50 to 57 and a half. So that was cup, and then the handle, and then the breakout. So this could be headed back towards the 65 region. So this is something to be looked at, that there's potential that Bitcoin has some more upside as it starts moving higher. EM, the emerging markets, had a very strong week. In fact, if you look at 2 successive strong weeks, the week of May 6th and May 13th, every candle has been white, so it's been moving higher. Each day over the next day moving higher. So last 2 successive weeks, a very strong move in EM, and that ended up with 3% move. So the 2 strongest were silver at 11.7%, the Bitcoin ETF GBTC at 10.6%, and then came emerging market EM. This is the MSCI ETF. Gold, which is also precious metal, was up 2.26%. It did well. It, as you can see, for the last 5 candles, the 3 in this week that were positive and 2 negative. But overall, there's a steady climb from in the 215 to 215 level to almost closer to, ended closer to 223. This is more upside as well, by the way. My target on SLV was closer to 31.732, and the target on GLD is closer to 235. So there's more upside on GLD as well. QQQ, interesting enough, had also a very strong week, but a little bit of a pullback the last couple of days. Again, market anticipating Nvidia's earnings, so next week will be a big barometer move on QQQ based on what happens to Nvidia. But this week, it did have a very strong week. At least the first 3 days, it moved up strongly. And the key here is a cup and handle here as well. From the 413 to 433, that's the cup. And I'll show in a separate chart. That breakout, so 413 to 433 is 20 point, at 22, 433, 453 to 454 was the target, which is what it met yesterday. It kind of touched 454.6 or something. Today was a slightly down day, only down 22 cents, minus 0.25%. Small caps have very interest rate sensitive. The fact that the 10-year yield has pulled back quite a bit over the last few days meant small caps got a big lift. They love lower expectations of interest rates, and the fact that long-term yields came down, treasuries kind of got a bid, and hence the yields came down, was actually good for the small caps. Spider, which is S&P 500 ETF, had a flat day-to-day, kind of 0.14%, but for the week, 1.65. So small cap at 1.85. The biggest mover among the core index ETFs was QQQ at 2.19, small cap IWM at 1.85, Spider at 1.65. TLT, which is the Treasury long-term ETF, did very well. That partly was because of the fact that the 10-year yields pulled down. So the long-term yield pulling down means this ETF does well, and hence it also had a 1.4% upswing for this week. DIA, which is the Dow Jones ETF, the Diamond, that closed close to 400. It's almost like 100 times this value is the index. If it's 40,000, then divide that by 100, 400. So it kind of closed right at 400, and actually from a Dow Jones Industrial Index, it closed over 40K, over 40,000 today, which is a big celebratory event from a round number perspective. The dollar ETF, UUP, has actually been minus 0.63%. So those were the 2 that were down for the week. The dollar, which is a safe haven kind of a move. And over the last couple of weeks, we can notice that it has been steadily on a downward trend. In fact, from the beginning of May, it topped out and near 28.9, and it has been pulling back for the last couple of weeks to 3 weeks. VIX also that was when the market bottomed out towards like the 20 or 21st of April. And from there, VIX had touched 21, had steadily come down to lower lows. In fact, this week, it touched lower lows of the entire year. It, in fact, closed below 12 handle. They call it 12 handle as in below 12 at 11.99. So VIX closed at the lows of the year. And that, from a bull's perspective, is a very bullish trend. When VIX trends lower, stays below 20, below 15, and all the way down towards 12 and lower, that means that the market overall is poised very bullishly. In many ways, this is volatility gives you a little bit of an idea about the put calls out there in the index, the S&P 500 index, and this in many ways means that there is a lot more calls than there are puts that are being bought, and that causes the VIX to kind of go down. So now what happens to the sector ETFs? And there are 11 of them. Technology was by far the biggest gainer at 3%, matching kind of what happened with QQQ. QQQ, as we noticed, was up 2.19, and technology actually is slightly higher than that. XLK was up 3%. 2.5 was the real estate, also interest rate sensitive. The fact that the long-term yields came down helped the XLRE to do very well this week, which is the home builders that fall under this. Healthcare had a 1.89, the third strongest sector. Financials also had a reasonably good move, especially the last 4 days. The big banks did quite well, whether it's JP Morgan, Citibank, and others. So that Wells Fargo, all of those, Bank of America, they all did well, and that had a nice upward move at 1.58. Utilities, we know, has been on a tear. Since that low or towards closer to April 16th, we can see it has been an absolute parabolic rise. I measure a target on this closer to 74. It touched 70 to 73 this week, and there's still a little more upside on it. But utilities have a very strong move for the last few weeks. And the bigger play on this, by the way, is what is being talked about in the market. It's not a defensive play. Utilities are getting an AI play. Why? Because AI build out means that data centers need to have more power consumption because of more and more of these servers that support these AI workloads being deployed at the data centers. And turns out Dominion Energy is a utility provider in the Northern Virginia area, and that by far has the highest number of concentration of data centers in the world. The density of data centers in Northern Virginia by far is the biggest in the world. And Dominion Energy in the recent earnings talked about massive power consumption of these data centers, and that's helping the utility sector playing the AI play. In terms of picks and shovels, this is more of the fact that you are seeing tertiary or the second derivative impact of AI in the utility sector. Energy had 1.2% move, especially today. It had a reasonably good move. Communications, that's where the internet stocks are, was up 1%. Staples at 0.76. It's headed towards a target near 80. So it's, I can see it closed at 78.21. So a couple of more bucks there on that target. Discretionary was up but less at only 0.34% for the week. Basic materials, though recently, some of these call it base metals, whether it's aluminum, nickel, some of those have actually been doing quite well. In fact, today, a big news was uranium stocks took a big move upward swing because Biden announced that they're not going to be importing any more of uranium. For a lot of the nuclear build out, we were actually almost 15 or 20% of our uranium imports were coming from Russia. And I didn't realize that that was still happening even after the embargo of Russia after the Ukrainian war. But that was what Biden made a big announcement, and that helped the homebound utility company Cameco, CCJ, and that had a big upward move, and I'll talk about that chart as well. Industrials was actually the weakest performance and negative for the week. This is where the transports are. For whatever reason, the transports have been lagging. Often that is a bit of a concern because transports talk about the overall economy and the strength of the economy. Transports are a big part of industrials, and of course there are the other companies that like the Caterpillars and the other construction companies as well. But the fact that transports had a down week is a bit of an economic concerned that there might be a bit of a slowdown that's being reflected in the industrials pulling back. But it could still be just a beautiful cup here with a handle, and we could perhaps break out above 126, which could be a very bullish move. We can see that there's already a bullish cross of the 20 above the 50. The 50, the red, is still climbing. The 20 had dipped below, but it took on and now has bullishly crossed it. So it's possible that this could just be a temporary handle on the industrial, and then it could break out above 126, and that could actually measure a lot higher, because this is from 120 to 126. A 6-point move, a cup and handle on that measures to 132. So there's a possibility that this could just be a temporary pullback in industrial and could catch up. Overall, if you look at the moving averages and how they are aligned, everything seems to be setting up very bullishly. You can see the XLK, the 20-day, has curved higher. It had bearish cross, but then it has curved higher. The 50-day flattened out, and we could perhaps get the bullish cross and the trend continues higher. The same thing with the real estate XLRE, the 20 now kind of curving higher, the 50 kind of basing out. This one also from the healthcare, the 20 about to come and cross above the 50 again. The financials already did the bullish cross, took out, and now both are climbing, which is positive. Utilities have never bearishly crossed. As constant, both the 20s have been climbing with the 50 and 20 steadily above the 50. So this by far is the most bullish looking from a chart pattern sector. This one here, the energy came close to crossing bearishly, but it didn't. It kind of plateaued out, and then the 20 is now kind of beginning to flatten and then maybe climb with the 50. Communications, XLC, 20 did dip below 50 bearishly, but now positively inclined again. 50 continues to climb, so this could be set up bullishly. Staples was bearish only for a little bit in April, but then the bullish part took over and now headed higher. By the way, this is the cup and handle I'm talking about on the XLP. You can see move closes to 73, and a 76.5 is the cup. So 3 to 6.5, that's almost like 3.5. Add that to 76.5 to 3.5, that's 80. So that's where I see that headed, and 80 is where XLP's target is from a cup and handle. This one, the discretionary, could also be, this is the cup. There could be a potential handle forming right here, and a breakout here could measure to 180 to one, say, closer towards 167. So that's 13. So it's headed towards 193 potentially if it breaks 180. So this could also turn out to be a cup and handle pattern on the discretionary. Basic materials did have a bearish cross, but now 50 continues to climb to 20 is now turned higher. Again, potentially a cup and handle here from 87 to 92.5. That's like 5.5. Add to 92.5. That could effectively take it to closer towards 98. So that's a possibility. And the same here with industrials. I already talked about the cup and handle between 126 and 120. That's a 6-point. If that breaks above 126, that's headed towards 132. So overall, sectors all seem to be very bullishly aligned. I can't see a single sector right now from the near term, the 2-month kind of plots that indicates any bearish trend. Seems like everything seems to be poised towards more upside in the market. Now, the key thing that I've often talked about as a barometer of the market near term is looking at this 10-year yield chart. And there was this ascending triangle pattern I've talked in the past. There is this the resistance level at 4.35 or 43.5, draw a horizontal line through that, and then the lows are ascending, 38.7, 40.38, 41.83. So that's the ascending trend on the lows, and a flat line on the resistance. That breakout from 37.85 to 43.54 measures to a target at 49.23. It came close, but didn't quite get there. It topped out at 4.73%, not 4.92, and pulled back, and it's come back to test exactly what was previously resistance is now support. It also is a bullish cross of the 20-day moving average above the 50. 20 is in blue, the 50 is red. They're both rising, but it came to test that, and then the last couple of days, the 10-year yield started climbing again, closing in near 4.42%. So this is something to be watched. If it's possible that we take this and start moving back higher, I would be looking for a potential test of the 4.92. Also, there are this, call it an island cluster, where there was a gap on either side of the island. This gap here is closer to 4.77, 4.78, which it didn't quite close. It came to 4.73, but didn't go as high as 4.77 to close out this gap from early November. So that's the other part to be watched. And this indicates also very beautifully in the TLT chart, which is the ETF for the long-term treasury. You can see a declining trend line through the previous tops: 99.26, 97.69, 95.75, 94.38, 92.442. Where did TLT stop? This move upswing, the counter trend move from 87 to 92 stopped exactly at the declining trend line. And then from there, it started pulling back. So this is something to be watched as well. Is TLT able to break above this? If that's the case, then there's a very good chance the 10-year yield will break below 4.35, and we will be down on a downward path again. And that'd be market bullish. Market will need the 10-year yield to start going back below 4.35, back trending maybe even below 4%. And that'll only happen when the market is very sanguine about the cuts, and there'll suddenly be discussion, not just 2 cuts, maybe more than 2 cuts could now suddenly start shaping up. Initially, market had given up on a near-term cut in June or July and thought that perhaps the first cut could be in September, but it could be back in the picture, something to be looked at. So now QQQ is what I wanted to show. This is a 2-hour chart. Every candle here is 2 hours, but the key is this cup and handle from 413 to 433.76. That is the measured target of 20 points. So 413 to 430 is 20.69. At 20.69 to 433.76, that measures to 454.45. It came right close, in fact, slightly crossed it to 454.69. So yes, what we have here is QQQ did meet its target for the cup and handle between 413 and 433. And since then, it has been pulling back. The last couple of days, it has pulled back. It has tested this rising 20-period moving average in red and rebounded. So the last couple of hours today, and this is options expiration today, so that's something to be also looked at, often based on where the pinning of the options are from a max pin perspective. Perhaps the money managers wanted QQQ not to dip below 450. So while temporarily during the day it dipped to 449, it made it back up by the end of the close and closed at 451.76, and that perhaps could have given the money managers a way to kind of eke out the maximum benefit from the options close. So that's the QQQ. Now, I'd said that this week was a big week of retail earnings. Home Depot's earnings were actually an interesting day. It did have a negative pullback. It pulled back very perfect number of 333. So that's the number it pulled back and on heavy volume. However, it didn't then catch a bid after the CPI on Wednesday, and then a slight pullback the last couple of days. So Home Depot said that their amount of their typical transactions that the customers are doing are lower ticket items. They're not making big spends, and that was kind of a little bearish from the consumers slowing down in spending, and so that's something to be watched. But it's potentially, this could turn out to be, because you can see beautiful positive divergence as Home Depot pulled from 396 to 326, especially with the last part of like 330 to 326 during the month of April. You see higher lows in the RSI. That's a beautiful positive divergence. And PPO has now crossed over. The black is over the red line. The PPO is above the zeros. The histogram is above the 0 level. And it's possible that if RSI can cross 50 and go higher, and this means a 326 to a 350 is a 24, 350 plus 24 is 374. It's potentially possible that Home Depot could have, after the test of 333, could continue moving higher. So that's something to be looked at, next couple of days or next couple of weeks. Walmart had a kind of a beautiful cup and handle, 61.44, pulled back to 58.35, 58.38. That's a classic double bottom, tested that 58.3 level twice, then came back to 61.35, and then a slight handle before earnings. So that measured from 58.35 to 61.35 is actually a 3-point move. Add 3 to 61.35, that's 64.35. It actually crossed it, hit 64.88, closed near 64.65. So it's met its cup and handle target. So it's an interesting pattern that Walmart had that it met. Now the question is, if there's more upside, how high could it go? And that it depends. If this 49, it's kind of a slanted cup and handle, not quite, but maybe we can look at the weekly chart of that to get a better idea. So in the weekly chart, we can see that there is 49 to 56. So if you take the 56 here again, so if that's close to maybe say 6.5 point to 56, that's 61.5. So it's already met that. So this part of 56 to 59, that pattern has been met. But if we take this pattern here, this cup and handle from 50 to 37, that's 12 points. That's 62. That's also been met. So no matter how far you stretch back and you look at the various patterns of Walmart, it seems to have met its target near 62 to 64. And so I'm not expecting much upside in Walmart. And also looking at staples, since I had talked about XLP, interesting enough, had, especially if you look at the shorter term hourly chart, XLP has a beautiful pattern between 76 and 78, and that's a cup and handle, pull back from there and break higher. That's closer to 80.5. So that's possible. If staples has got a couple of more points, Walmart, once the staple stops out, may not have much more upside. But the key here is target, and this is the chart that I had talked about. Target, interesting enough, if it can break 165, it could have a significant more upside. And because from 154 to 164, that's 20 points. At 20 to 164, that's 184. So that could be a reasonably good upside in target. That's the hourly chart. But if I go to the weekly chart of target, here it's even a bigger move. From 100 to 180, here's 173. That's a bigger cup. A handle pullback from 180 to 154. So 100 to 180 is 80 points. At 80 to 180, it's 260. So that's even above the previous highs at 250 and 239 here. So that's what I would advise for the long term and for the cautious investors, not to anticipate the cup and handle. Let it break above 180 with volume, confirming that it is a true cup and handle. Then you still have reasonably good upside. If you are buying it near term, I would put a stop loss below 154, because if that breaks, there's a possibility that this is kind of, instead of a cup and handle, this could turn out to be an inverse head and shoulder. So let me show you how that inverse head and shoulder could be. If I take the level right here, that's the neckline, and this is the left shoulder right here. That's the level of the left shoulder. This is the head around 100. That's the head. And this could turn out to be a right shoulder pullback. And we could see target pullback towards that 130 level, right here. And then after testing, then it could kind of form the right shoulder and then break higher. And if that happens, that would be a much, much nicer move. From 130 going all the way to 260 would be 100% move. I mean, that's a big move for a company like Target, but that would fundamentally mean that something has drastically changed in Target's business model of how they're able to get that much of fundamental improvements to get them to that kind of move. But the cautious move again is wait for this resolution. If it pulls back to 130, I think there'll be very strong support. That would be, in fact, that's also closer to 135 is its 50-week moving average, also a good support level to pick it up. And then from there, if you see that movement from 130 to 260, boy, that's 100% move on a retail stock. That would be quite a move if that happens. So something to look at. So with that, let me show you Nvidia. That earnings is coming up next week. Nvidia potentially, and this is where I am mapping out what could happen. This is right now neckline, kind of at the 970 to 967, around that 970 level. So this is potentially a left shoulder around 862. This is the head at 756. And potentially what we could get is, if expectations are extremely high, and of course the call it the top 4 internet companies, or the top 4, they're nicknamed as MAMA, the Microsoft, Alphabet, then Meta, and then Amazon. All 4 have announced big capital spending on GPUs. So we know that there's a very strong pipeline for NVIDIA to fulfill those orders, and potentially they will perhaps again, not just beat earnings, but also have a very bullish forecast for the immediate future. But for whatever reason, if there's a whisper number that NVIDIA misses and you do get a pullback, so this could be the neckline test near 970 early next week. After the earnings on Wednesday, if you do get a pullback to 862, that could potentially be a buying opportunity, a right shoulder move, and then a breakout above that. So if a breakout from 756 to 970, that's closer to 214 points. At 214 points to 970, that's close to 1185. So there's a possibility that if NVIDIA breaks 970, you could get a level as high as that. So that's something to look at NVIDIA, and I think potentially that's a very much a possibility. But instead of just chasing it before earnings, wait for earnings. I don't think it'll jump to 1170 in one shot after earnings next week. If any, it may break 1,000 and kind of pull back. So see how it does. If it pulls back, then buy it on the pullback and then ride it higher. But that's something very interesting to watch next week. Is this going to be an inverse head and shoulder with the left shoulder 862 to 970, the head from 756 to 970, which this week it only touched 958, but there's a possibility by Monday or Tuesday next week we may get the 970, and then maybe 862 is the golden opportunity to pull back on the right shoulder and then play the breakout. If it does do a cup and handle and break out higher, in that case, just wait for a pullback and only then, instead of chasing it and taking a chance of buying it this late in the game. For those that have bought it a lot lower, like in the 470s, imagine the move it has had from the beginning of this year. That's a classic double. 473, a double of that is 950. It is close near 950, like touched 950 this week. So that's a double, pretty much 80-90% move of NVIDIA year to date so far. And there's potentially more upside possible if they continue to announce a very bullish quarter and future projections. Silver, I talked about giving everyone a forecast of where I think it's headed. So you can see a beautiful cup and handle here. Let me quickly draw it out. So this is the 24.9. Sorry, not that. Let's draw the parabola. So 24.9. Let's do the 16.19 and 23.94. So that's the cup. Then this was the handle that it formed over the last, part of 2023, and then it has broken out. So that measured target, if I take the measured target on that, that's 23.94 to 16.19. That's roughly 7.75. So 7.75 added to 23.94 is 31.69. So that's where I think silver, the ETF SLV, is headed, 31.69. So that's the potential target of SLV. We touched 28.79 with a very bullish candle. Look at how bullish it was. Started at the lows of the week near 26, closed near 29. Three more points to go on this to top out. And I would not chase it beyond that. At least that's the near-term target. From there onwards, if any, I would play a inverse ETF that shorts the silver called ZSL. And I would look to ZSL, buy ZSL to play it once it gets to that target. With that, I did want to talk about the uranium because of Biden's announcement to stop importing uranium from Russia. So the biggest uranium miner in US is Cameco, CCJ. That has been on an absolute wonderful climb as well. So you can see here from 20 to 32, that's 12 points. 32 plus 12 is 44, 45. It already met that target, but it's been climbing since then. This now is potentially forming an inverse head and shoulder. Let me show you what that pattern looks like. And there's a possibility that we could have even more upside in Cameco. So this right here is the neckline. So this is the left shoulder right here at the level. Here's the left shoulder. That's the left shoulder. This is the head at 39.74. And potentially it's already formed the right shoulder at 45. So it's pretty much complete. Today it eked out a slight close above the neckline. So you can notice that the neckline is near 52, 53. It crossed 53 and closed above 53. So if you measure 39.74 to 52.64, that's closer to 13 points, almost 12.9. At 13 to 52, that's close to 65.54. So that target of the inverse head and shoulder on this is closer to 65.54. That's how I would compute that target, and which means there's still more upside on Cameco, something to look at for those that believe in the nuclear energy play and the fact that there's going to be a supply crunch because we're not going to get any of that supply from Russia anymore, which means Cameco becomes an immediate beneficiary of that. So that's a play that one could look at for in the material space. With that, thanks for listening in. Just to recap, we talked about, let me save this in the chart list. So we talked about a recap of the markets. Everything seems to be extremely bullishly poised, especially the sectors. All sectors now, after the bearish move in April, seem to have bottomed out, and the 20 days now began to turn higher to cross above the 50. Each and every sector seems very bullishly poised. I don't see any bearish right now. And if any, they could be upside in the continued in the market. If any, we might get a pullback, but the key here is this barometer to be looked at is if we do get another climb of the 10-year yield, then expect a correction in the market. So while 10-year yield maybe touches 4.9, if that happens over the next, sometimes towards June, late May to June, we might get a bit of a pullback. If that does happen, that would be a golden opportunity to buy back stocks on the pullback, because after that, it could turn out that we might start getting a top out of yields and beginning to decline again. But key is if the market continues its climb, then this means that we are breaking below 4.35 and headed back to 4% or even lower. And that would be very bullish for stocks. With that, thanks again. Look forward to talking to you all next week.